Okay, today we will look at the features of stocks, chapter 10. The agenda is I will show the finance endowment and common stock, dividends, stock splits, dividend reinvestment plans, the purchase of stocks, evaluation using dividends, and wrap up. As you know, we have savers and borrowers in uh, the financial system, and we have financial institutions and financial markets. We already look at the present value and future value formulas, perpetuity annuity formulas, return formulas, and risk measurements, and we'll talk the financial statements. And now we will look at the stocks. Um, the, the firm's sources of finance are either debt or equity. So stock represents equity ownership in a corporation, while there may be many different types of debt instruments. There are only two types of stocks, preferred stocks and common stocks. As the name implies, a preferred stock has a preferred or superior position. Common stock thus represents the final claim on the firm's earnings and assets, while equity represents the residual claim. It is still a claim, and the managers and employees work for and are responsible to the stockholders. Some corporations have two or more classes of the common stock. For example, Berkshire Hathaway has Class A and Class B common shares. Having different class of common stocks facilitates different of the corporation by a few stockholders, and the voting rights often differ between classes. For the vast majority of firms, the owners and managers and the employees are one and the same. The owners of a small store must perform all the roles required to operate and manage the business, while the owner may employ individuals with special skills, for example, an accountant or a lawyer, to perform specific tasks in management, marketing, and financing decision, all fall on the owner's manager. Since the owner and manager are one and the same, it seems reasonable to assume that management decisions are made with the welfare of the owner as a primary consideration. In large corporations, on the other hand, the owners, managers, and employees differ, and the owners are represented by an elected board of directors. The board employs management, then in turn hires the various individuals who staff the operation. You could assume that the goals of management are consistent with the owner's goals, since the managers have a fiduciary responsibility to the corporate owners. That is, they are the agents of the owners. However, such an assumption may be at odds with reality. For example, higher salaries may be a goal of individual managers, but the higher salaries will reduce earnings and come at the expense of the owners. So, in summary, in a firm, we have the firms are financed with either equity and debt. As you remember, assets and liabilities, we have debt and equity, asset. So debt and equity finance the assets. Okay, so equity is the ownership in the corporation, and it includes the residual claim, and it's riskier than the debt from the investor's perspective. So we have two different stocks, preferred stocks and the common stocks. The preferred stocks enables a preference and a monetary payments. It is a preferred and superior position. And the common stock is to represent the final claim on the firm's assets and earnings after the firm has met its obligations to creditors and preferred stockholders. All firms issue a common stock. It is anticipation of dividend payment and the price appreciation that induce investors to purchase common stock. So we have agency problem between owner and manager. So owner and manager is usually the same person for a lot of businesses, specifically small businesses. But for larger firms, managers are different from owners. Management is the agent of the owners, and the agency problem is the potential conflict of interest between management and the owner. So manager's interest is usually deviated from stockholders' interest. For example, management want higher salaries, but higher salaries will reduce earnings, and they can come after the expense of the owners, in other words, the shareholders. How to reduce the potential conflict of interest between the agent and owner by linking the welfare of management and the owners together. But how? Developing a reward system based on the performance of the management, such as stock options in management compensation or employee payment. The second way is to develop a structure in which the chain of responsibility starts with the owners and the flow to the employees. So the rights of common shareholders. So the shareholders select board of directors, and the board of directors is responsible to stockholders, and the board of directors select the management, all the CEO, CFO, and all the CTO, all the managers and management team, and the management team is responsible to the board of directors. So voting authority to elect the board of directors. Voting authority. Who has the voting authority? The voting authority is stockholders. Stockholders select the board of directors, and cumulative voting helps the minority to gain representation in the board of directors. Yes. So common stock provide preemptive rights and rights offering. What is a preemptive rights? It's the right of current stockholders to maintain their proportionate ownership in the firm. What is rights offering? The sale of new securities to stockholders by offering them the option to purchase new shares. So preemptive rights, shareholders have the right to maintain their proportionate ownership of the firm, usually costly. So some firms have changed their bylaws to eliminate the preemptive rights. Rights offering is the sale of new securities to stockholders by offering the option, in other words, right to purchase new shares. Dividends. A dividend policy is after a corporation has earned profits, management must decide what to do with these earnings, retain them, and to invest in new projects, new investments, or increase each stockholder's investment in the firm, or distribute them in cash dividends. If the earnings are distributed, the cash flows out of the firm. If the earnings are distributed, the cash flows out of the firm. If the earnings are retained, management will put the funds to work purchasing income earnings, assets, or retiring outstanding debt. To see the impact of distributing or not distributing cash dividends, consider the equity section of the firm's balance sheet. On most balance sheets, stockholders' equity is listed after the liabilities and the deferred taxes. And in its simplest form, equity consists of three entries: the stock outstanding, additional paid in capital, and retained earnings. So in summary, dividends distributed from earnings, they distribute regularly. Quarterly dividends, they distribute in quarterly basis, and extra dividends and irregular dividends can be distributed by the company. There could be two types of dividends: cash dividends and stock dividends. Cash dividends is from earnings and paid in cash. Stock dividends paid in additional shares of stocks. You remember the payout ratio. What was the payout ratio? Payout ratio is dividends paid per share over earnings per share. This is per share. So earnings per share is the earnings per share is the net income over number of How can we calculate earnings per share? So from income statement, we have net income over number of shares outstanding. So you will find earnings per share and you will find the dividends per share. So dividends per share over earnings per share gives you payout ratio. So the other topic is the cash dividends distribution. So distributing dividends takes time. And the first step is the dividend meeting of the firm's directors. If they decided to distribute a cash dividend, two important dates are established. The first date determines who is to receive the dividend. On a particular day, the ownership books of the corporation are closed, and everyone all owning stocks in the company at the end of that day receives the dividend. This is called date of record. If the investors buy the stock after the date of record, they do not receive the dividend. They don't receive dividend. The stock is purchased excluding the dividends. This is referred to as ex-dividend. Until this day, if you buy stock, you purchase the stock excluding dividend. The company does not pay dividend. So it's kind of confusing because, as you see, the ex-dividend date is prior than the date of record. Why is that? Why? So the ex-dividend day is 2 working days before the date of record because the settlement date is 3 working days after the transaction. So if you buy stock at July 30th, the settlement is T plus 3. That means you will own the data after 3 days of your transaction. So that's why the ex-dividend day is the prior than the date of record. The second important date is the day that the dividend is distributed, or the pay date or distribute date. The distribution date may be several weeks after the record date, as the company must determine the owners on the record date and process the checks. The company may not perform this task itself. Instead, it uses its commercial bank, for which service the bank charges a fee. The day that the dividend is received by the stockholders is thus likely to be many weeks after the board of directors announced the dividend payment. So let's look at the dilution. So some companies, some firms distribute stock dividends instead of cash dividends, and they distribute stock dividends in addition to or instead of cash dividends. For example, Tootsie Roll distributed a 3% stock dividend in addition to its cash dividend for every year through 2000 and 2016. According to the Tootsie Roll's annual report, the company has distributed a stock dividend for over 50 consecutive years. Stock dividends alter the entries on the firm's equity section of the balance sheet, but they have no impact on the firm's assets and liabilities. Since assets are neither increased nor decreased, stock dividends do not affect the company earnings capacity. So as you see from the first table, this is the equity section of the balance sheet, and you will see the equity. We have the $1 per common stock, and 2 million shares authorized and 1 million outstanding. As 1 million is outstanding, 1 million multiplied by $1. So the equity section here, 1 million. Additional paid in capital, 500,000. Retained earnings, 5 million. And in total equity is total 6.5 million. So a stock dividend does not affect a firm's assets and liabilities. Only the entries in the equity section of the balance sheet are affected by the stock dividend. The stock dividend transfers amounts from retained earnings to common stock and additional paid in capital. The amount transferred depends on the number of new shares issued through the stock dividend and the market price of the stock. If the above company, the Fin3003 company, issued a 10% stock dividend when the market price of the common stock was $20, this would cause the issuing 100,000 shares with a value of $2 million. So what I'm simply saying is that the company issuing new stocks. So first they have 100 million outstanding stocks. So they increase 10% outstanding stocks and they issue new 100,000 stocks. In total, they have 100. They have 1 million and 100,000 stocks outstanding. And the value of the share per share is 20. So they increase 100,000 shares. Each share is the price of each share is $20. So they increase $2 million. So where the company can pay $2 million? So they just issue a new stocks and they will distribute these 100 shares. So the funds, they're not paying in cash, but they are paying in stocks. But in the equity part in balance sheet, the return earnings need to be subtracted from 5 million to 3 million. And the 2 million amount is subtracted from the retained earnings and transferred to the common stock and additional paid in capital. So 2 million goes to 100,000 goes to the here equity $1 per common stock, and 19 and 100 and 1 million and 900 goes to the paid in capital. So nothing changed in equity part, only just the transfers from retained earnings to additional paid in capital and equity $1 per common stock part. So nothing changed in equity part and the balance sheet doesn't change. So although there has been an increase in the number of shares outstanding, there has been no increase in cash and no increase in assets that may be used to earn profits. All that has happened is a recapitalization. The equity entries have been altered. Only the equity entries is changed. The stock dividend does not increase the company wealth, but does increase the number of shares the company issued. And in this example, if you owned 100 shares before the stock dividend, you had stock worth 2,000. Let me clear here. So before, so okay, so if you own 100 shares before the company issued new stocks, new dividend, you have the stock worth 2,000 because the uh, um, the worth of stock is $20, and it means you have 20,000, 2,000. After the stock dividend, you own 110 shares, and the value should be same because there is no reason for the value increase. The value should be same, and they issue more stock. They increase. They give you 10 more stock, and the price should be decreased. How can we find that? So the value is 2,000 over 110, which is $18.18. Why does the price of stock fall? The answer is that there are 10% more shares outstanding, but there has been no increase in the firm's assets and earnings power. Think about this way. We have assets and liabilities. We have the company has debt and equity and assets. Nothing changed in assets should be the same. The total number of assets should be equal to total number of liabilities and equity. Right? Liabilities and equity. And nothing is changed in assets part. The only company just increase the outstanding shares. So we don't expect any um, uh, any increase in value. So um, that's why the stock price fell. So the answer is that there are 10% more shares outstanding, but there has been no increase in the firm's assets and earning power. The old shares have been deleted, and hence the price of the stock must decline to indicate the dilution. So what does dilution mean? Dilution is reduction in earnings per share as the result of issuing additional shares. If the price of stock did not fall, all companies could make their stockholders wealthier by declaring stock dividends, but investors will soon realize that the stock dividend does not increase the assets and earnings power of the firm, and they will not be willing to pay the old price for a larger number of shares. The market price will fall to adjust for the dilution of the old shares, and that is what happens. As you see, the $20 just declined to $18.18. So the major misconception concerning the stock dividend is that it increases the ability of the firms to grow. If the stock dividend were a substitute for a cash dividend, the statement would be partially true because the firm still has the set cash that would have been paid to stockholders if a cash dividend had been declared. The firm, however, will still have the cash if it did not pay the stock dividend, for the firm may retain its cash and not pay a stock dividend. Hence, the decision to pay the stock dividend does not increase the firm's cash. It's decision not to pay the cash dividend that conserves the cash. So, in summary, price adjust for the stock dividend, and if you own 100 shares before the stock dividend with the price of $20 per share, then 10% stock dividend percent increase stock dividend causes a 20 stock price to fall 18.18. So you have 100 shares, $20 should equal to 110 shares multiplied by the stock price. NIV stock price after dilution. So 100 multiply 20 over 110 is equal to 18.818. Okay. Stock splits. Stock splits after the price of the stock has risen substantially. The management may choose to split the stock. For example, VF Corporation split stock for 4-for-1 during 2013. This stock split lowers the price of the stock and makes it more accessible to investors. The VF's stock sold for $200 before the split. Implicit in this statement is the belief that the investors prefer lower priced shares, and that reduces the price of stock being benefits the current stockholders by widening the market of for the stocks. So same logic when before the stock split company has 1,000 shares worth, let's say, $20. The market value of the company, as you remember, the market cap is 20,000. So they decided to split the stocks, let's say 2-for-1, and they have 2,000 shares, and the value should be equal to $20,000 market cap. So what's the value of the price? New value is after stock split is $10. The value of the company is not changed only from the stock splits. The value of the company market cap, it will be same. The only change is goes to the stock price. So, like the stock dividend, the stock split alters the equity section on the balance sheet, and it does not affect the assets and liabilities of the firm. It does not increase the earnings power of the firm, and the wealth of the stockholders is not increased unless other investors prefer lower price stocks and increase the demand for the stock. So the equity section of a balance sheet used previously for illustrating the stock dividend will now be employed to demonstrate the 2-for-1 stock split. As you see, the par value was $1 before stock split. Now the par value is 50 cents. And the equity section of the balance sheet used previously for illustrating the stock dividend will not be employed to demonstrate a 2-for-1 stock split. In a 2-for-1 stock split, one old share becomes 2 new shares, and the par value of the stock is halved from $1 to 50 cents. There are no changes in the additional paid-in capital, no change. Retained earnings, no change, and total equity, no change. So, as I explained, it causes downward price adjustment. If the price was, if the company experienced 2-for-1 stock split, and let's say the prior price is $80, the price declined to $40. So we have another question here. What if the stock price is 27? If the stock price is 27, and what will the price be after 3-for-2 split? Simply, you will just divide 2.3 over 2. It is 27 to 3, 9, $18. Dividend reinvestment plan. Many corporations that pay cash dividends also have dividend reinvestment plans, sometimes refers to DRIPs. This permits stockholders to have cash dividends used to purchase additional shares of stock. In many plans, the bank acts on behalf of the corporation and its stockholders. The bank collects the cash dividend, and in some plans, offer the stockholders the option of making additional cash contributions. The bank pulls all the funds and purchases the stock in the secondary market. Since the bank purchases a large block of shares, it receives a substantial reduction in the per share commission cost of the purchase. This reduced brokerage fee is spread over all the shares, so even the smallest investors receives the advantage of the reduced brokerage fees. The bank does charge a fee for its service, but this fee is usually modest and does not offset the potential saving in brokerage fees. In the second type of the reinvestment plan, the company issues new shares of stock and the money goes directly to the company. The investor may also have the option of making additional cash contributions. This type of plan offers the investors a further advantage in the brokerage fees are entirely circumvented. The entire amount of cash dividend is used to purchase shares with the issuing cost paid by the company. Perhaps the most important advantage to investors of dividend reinvestment plan is to forced savings. Such forced saving may be desirable if you wish to save but have a tendency to spend money once you receive it. The plans also offer advantages to the firm. They create goodwill and may result in some cost savings. For instance, lower cost of preparing and mailing dividend checks. The reinvestment plans that result in the new issue of stock also increase the company's equity base. So in summary, plans that permit stockholders to have cash dividends reinvested in additional shares instead of receiving cash, they call it dividend reinvestment plan. Additional cash contributions may be allowed. A bank may act on behalf of the firms and pools the funds to purchase stocks in the secondary market, like New York Stock Exchange or Nasdaq. At a lower at a cost lower than commission fees. Companies may issue new stock and the money goes directly to the company. Issuing cost often paid by the firm. The dividend reinvestment plans are automatic and easy means to save forced savings. Repurchase of stocks. A firm with cash may choose to repurchase some of its stocks. Stock repurchases decrease the number of shares outstanding. Since their earnings will be spread over fewer shares, the earnings per share should increase. The higher per share earnings then may lead to a higher stock price in the future. So corporations with cash may reduce the number of existing shares through buyback programs. Before the buyback programs, let's say ABC company have 1 million outstanding shares, and they decided to buy back the stocks, and the shares outstanding decreased 500,000 from 1 million. So let's say the share price before stock purchase was $10, and you multiply by the $10 per share by 1 million shares outstanding, which gives you the market cap. Market cap should be same before and after the buyback program. So you have 10 million should be equal to 500 number of shares multiplied by the stock price. Stock price after buyback program. So it's now $200. So the increase in outstanding shares may increase earnings per share. Why? Because as you remember the earnings per share calculation from the prior slide. Yeah, earnings per share is the net income over number of shares. So number of shares declined and earnings per share increased, right? And let's go look at valuation of stocks. The value of an asset is the present value of the future cash flows. So as you remember, we have time 0, time 1, time 2, time n, right? And we have dividends for time 1, dividend for time 2, and dividend payments for time n. So how can we calculate the present value of these dividends for today? It's like a perpetuity, as you remember. Price 0 times 0 price of the stock is equal to dividend 1 times 1 over cost of equity. So start with constant, so we have constant dividends, same amount of dividends for forever. So the calculation is dividends 1 over return investment. So start with growth in dividend. You can find, you remember the calculation. So dividend times 0, we should find the dividend times 1. So we are calculating dividend paid in time 0 multiplied by 1 plus growth rate over return on equity minus growth rate. Let me clear here. You will see, as you see, for 0 dividend 1 minus return on equity over return equity minus growth rate. So example of stock price is today stock price for Tesla is 816.88, and during the coronavirus it just goes to 400 level and then go back to 600 level again. So when you look at this is just Yahoo Finance. You can check the any stock price is traded in the United States or all around the world. Just look at, you can go at Yahoo Finance or Bloomberg terminals in GPL library or the finance building. You can just go and look at the search for the stock prices using Bloomberg terminals, or you can use your web browsers and look at Yahoo Finance or other websites, including TradingView or Google Finance, and you will see each stock prices, the daily closing price, daily open price, instant bids, ask prices, days range, the minimum and maximum price, 52-week range, and the volume of the company, how many companies stocks traded in a specific day, average volume for the company, and market cap, beta, price to earnings ratio, earnings price ratio, and earnings date, all the information. Problem 1. Consolidated Edison Corporation is a regulated utility company that serves the New York City area. Suppose County Edition plans to pay $2.3 per share in dividends. Dividends 2.3 in the coming year. D1. If its equity cost of capital is 7%, and dividends are expected to grow 2%. Growth rate is 2% in the future. Estimate the value of the common stock. As you remember, P0 is equal to dividend 1 over cost of capital minus growth rate. So you can put here dividend is 2.3 over 7% minus 2%. Let's see. So the price is 46. So quick wrap up. Today we look at common stock and residual claims, cash dividends and stock dividends, stock split, stock valuation, stock dilution, and finally we look at the stock valuation calculation, looking at the dividends and the growth rates. So please read your notes, read the PowerPoint slides, chapter 8, 9, 10, and complete the mindset exercises, quizzes, video reviews, and the PowerPoint and flashcards. And all the questions will come from the mind type exercises, quizzes, plus book problems at the end of each chapter. Thank you for your attention today, and see you next time.